Well, our next guest says bearish bets by hedge funds on S&P 500 index futures have increased to the highest level since before the financial crisis 3 years ago, back in 2008. Ann Bartels is head of technical and market analysis at Bank of America Merrill Lynch. Ann, thanks so much for being with us. Also, John joining in on the conversation. So what does this signal when you have that many bets against the S&P futures?
Well, it's significant. It's a very extreme short position. And it is important, but I typically use the NASDAQ 100 because it has a higher beta as being more important. And they don't have a statistically significant or extreme short position, the NASDAQ 100. What I actually think is more important, we recently released our short interest data. And although short interest rose sharply, 8%, as of August 15th, when we do it as a percentage of volume, what's called days to trade, it's actually below the 10-year average. It's at 1.5 times versus 2.4 times the historical average. And even when we looked at the ETFs, we could not find an ETF that had a significant short position. So although we're seeing the shorts in the S&P 500, we still believe that hedge funds have the ability to significantly short the market should we break below 1100 on the S&P 500.
So this is what, given all that, a bearish signal for the markets or what?
Well, to me, it's a bearish signal, absolutely, because short interest represents a floor. In other words, people have sold, and if you have a lot of shorts, you only fall so much. And we don't have that floor. We don't have a safety net on the market. And we know a number of the hedge funds, particularly the long-short, the event-driven, are having a really tough year. They're down on the year. And they don't want to be down, right? You don't get paid if you're down. So if we have a trend that goes lower in the market, I think they have the ability to significantly short the market, driving prices on the S&P lower, and my mark is 1100 on the S&P.
But aren't there others where shorts are being covered? Aren't there other index futures that are seeing some covering? The Russell, is it not?
Yeah, the Russell, though, even in the futures market, is still very short, and it has been actually short for a significant period of time. And from day to day, you're going to get some short covering, but the level of shorts is nowhere near where we saw in 2008 and 2009, and I think that's what's important.
So your takeaway when you look at the charts, Ann, is that you want to stay defensive, right? That's the conclusion.
The conclusion is there's no reason to have a very long position with the positioning of the charts. And really what we're most concerned about is the banking system in Europe. That seems to be leading. And when you look at the index over in Europe, just for the Euro bank, so this would exclude some of the other European, this is just the Euro region, they're now down to their 2009 lows. So I think this is very critical to watch to see whether or not they're going to break to new lows.
You know, you raise a good point, though. When we got to the lows in 2009, the rally that we saw for the next year was led by banks. And there was so much uncertainty around the banks at those lows, but you ended up making 4 times as much money owning banks over that year than you did over the safer stuff, like utility stocks.
Well, that's because we entered a cyclical bull market. The lows in March 09 led to a 105% rally, led by the financials in the early stages because they were so depressed. I call that kind of like a bungee rally, right? They're so taut, they just rally right back. But now we seem to be trading a little bit more similar. It's kind of eerie to 2008, 2009, with these 3 to 4% daily swings within the market. And the other time where we saw this amount of volatility was during the 1930s and the early 1940s. Neither were really great periods in the market. We eventually get out of it, but the way I like to look at it is we had this 105% rally. The risk is now that we're in a correction. The question is how much of a correction? Typically, you correct 1/3 to 1/2 of a rally. 1/3 is 1100, a half is 1020.
All right, Ann, thank you.
Thank you for having me.